Welcome back to Real Talk with the Pros. I'm the associate broker here at Picket Fences Realty.
And I'm Chris McLaughlin, and today we're going to dive into government-based loans, like the USDA, the FHA. Might not know what the abbreviations stand for, but we're going to break it down for you.
Ray's joined us today for our final of a series of 3 that we have done with him, all about loans, different types, conventionals, VAs, USDA, all those initials. He's going to explain it all to us.
So grab your coffee, settle in, and as we say in New England, let's get started.
Yeah.
When buyers hear USDA and FHA, which are government loans, those initials get thrown around a lot. What do the initials actually stand for? And I know as a realtor, we hear FHA, oh, I have a first-time home buyer's loan. So
Right.
that is not what it stands for.
Sure.
So kind of unpack those two loans for us.
Yeah, no, I hear that a lot as a lender. They'll call in and they're like, well, I've already used my FHA loan. And I'm like, it's not first-time home buyer loan is what a lot of people think the F stands for. It's Federal Housing Administration. And the fact is you can use a FHA loan as many times as you want. However, you can't have multiple FHA loans at one time. There are a few exclusions to that, like if you're moving far enough away from your job or things like that. But as a rule, you can't have 2 FHA loans at one time. But there are a few exemptions there. And then the USDA loan, it's U.S. Department of Agriculture, which I don't know the background exactly behind that program, or I just know that it is a rural loan, right? You have to live in a rural area. However, like what we might think as rural and what they determine as rural are 2 different things, right? And why I say that is, I mean, we're in Marion County right now, and all of Marion County is eligible for USDA. All of Harrison County is eligible for USDA. Mon County has a few areas that are like blacked out, but for the most part, a lot of Mon County is, available. So I wouldn't really call those rural areas, right?
No,
so
right.
You'd be surprised the areas that qualify and that don't. But anyway, those would be the acronym differences, and there's pretty major differences between the 2 loans. But I have a feeling you've got some questions that are going to dig deeper on that, so I'll try not to go sideways.
I know when I bring up when we're looking for loans and tell them things to look for, and I say USDA, and they go, isn't that for farmers? Isn't that for farms? So we get that a lot. So there is some confusion of what these 2 loans are. So that's why we're going to go over them today. And I appreciate, again, you've done a series of podcasts with us on different loan types, and this is why we do it, so we can just kind of get down into it and find out what's going on.
Sure.
And if someone qualifies for both these loans, how do you figure out which one better suits them? Is it the location, is it the income, or something else?
So if they qualify for both loans, I would obviously present both. In my mind, I think that USDA is oftentimes a little better deal. So if you qualify for both, then likely you would consider USDA as a more solid option. And the reason why is the monthly insurance premium is a little cheaper on USDA. The upfront mortgage insurance premium is a little cheaper on USDA. Rates are typically pretty comparable, right? So, and the down payment requirement is less on USDA than it is on FHA.
Now, is the process to get from the loan process to closing on the USDA a longer process than the FHA, or are they comparable, or does it matter?
Only because of the
Shutdown.
because of the government shutdown. Other than that, no. Typically, it's a very similar process between the 2. With FHA is super flexible as far as credit goes, and they allow a lower credit score than USDA. So we can maybe like separate them to chat about them a little bit, because they're very different, right? What the requirements are different, the way they're looked at, the way they're underwritten, all the things are different. So we could chat about FHA first.
Okay.
So FHA has no income limits, right?
Okay.
So you can qualify even if you make $1 million a year. You could still qualify for an FHA loan. The only limit that they have is a house price limit. And we're going to have to look that up.
Okay, no worries.
I'll let you look it up on your phone while we're talking. Because it changes every year, and I think that it's just about to change for 2026.
Oh, okay.
So anyhow, that will make a difference. But there is a house price limit, but there are no income limits. So if you're not a first-time home buyer, that makes no difference. If you make a ton of money, that makes no difference. Right. And they are more flexible on their credit in general. FHA technically goes down to 500. And if you do have a 500 score, that requires a low score like that. You're going to have at least a 10% down payment in order to be in a situation where you could qualify for 3.5% down. You have to have a 580 score or better.
Okay.
So you were saying about 2026 that it was changing. It does say that the expected loan limits for FHA mortgages to rise more than $17,000 for floor limits and over $39,000 for ceiling limits in approximately over 3,000 counties. I don't actually see.
Should be like
here it is.
Getting close to 600,000.
Yeah, there it is. 541,288.
Okay.
There you go.
So
Thanks to the web.
Right. And the house price makes no difference.
Mm-hmm.
That is your loan limit, right? So you could buy an $800,000 house, and if you have the money to put down to get you to that loan, then you could qualify for a FHA loan.
And that was going to be my next question. Is there a magic number for each of the loans? And you said 500 for that one and then 580 for the other one.
Right. Right. So they offer 3.5% down to 580. Mm-hmm. And then if you have 10% down, you can go down to 500. Mm-hmm. Again, that's one piece of the approval process. So a lot of people are like, I got my 3.5% and I've got a 590. That does not mean that you are going to get approved for that loan, right? If you have a 590 and 3.5%, that is not all of the pieces. And occasionally, I'll have a 590 that the only way I'm able to get them approval is if they put 10% down, right? And I've gotten that call a lot where, like a realtor who knows enough about FHA lending to say, hey, listen, like, I don't know why you're being asked for 10% down.
Right.
They only require 3.5% down. Well, it's not to make me feel better.
Right.
It is because even that's the minimum down, right? So there is no maximum that they could require.
Right.
So ultimately, someone with a 590, as I work through it, I still may require a 10% down payment because that's what it takes to get their loan approved. But the fact that the program is out there, it has flexible debt to income. Obviously, we've already talked about the credit scores. I mean, that's pretty flexible. I mean, the numbers I'm throwing out there are low credit score numbers, and they're not always indicative of people needing, like someone I'm sure could argue and be like, why would you even give somebody a loan with a 550 credit score?
Right.
Well, maybe their life has changed.
Right.
But their credit score hasn't caught up with that yet. Potentially it was an isolated incident that caused their credit scores to get there. Potentially they've learned their lesson. And, you could tear your credit down in a month, but to rebuild it, it could take years, right? And there are things you could do to rebuild it quicker. But at the end of the day, the idea that somebody has a 550 credit score is not a hard, they don't deserve a loan, right? And, so it's nice that FHA is out there and gives that availability for someone to get a mortgage once they've kind of straightened their lives out a little bit or made the changes and they're on the climb up. And some people, it's not always terrible credit that gets you into that 500 range. Sometimes it's a lack of credit, I mean, if you don't have a lot of credit and then you get a collection.
Right.
Well, the credit company, credit scoring agencies, they're looking at what's available, right? So if you've got no real good debt and a $800 collection from AT&T, your credit score's rough. And maybe that $800 collection wasn't your fault. Maybe it's a situation where you disputed it and it just didn't win, or they still put it against your credit. But it's not always that credit score. It's not a very good factor sometimes, and I mean it's a guideline, but
Right.
it doesn't always indicate whether someone should or should not get a mortgage.
Right.
That's good to know because I don't think people often realize that if you've never had a credit card, especially younger couples, people that are actually first-time home buyers, they've never done anything like this,
Right,
so they
right.
haven't built up a credit, and they're like, how can I have bad credit if I don't have
Well,
credit?
And there's a big misconception, and I bet we could all kind of understand this in a way, but like a lot of credit cards have $25 payments, right? And somebody screws around, a bonehead move, and misses that $2,500 payment. They have no idea. You might as well miss a car payment at that point, right? I mean, to a 30-day late is seen pretty detrimentally on your credit report, whether it's a $25 payment or not. And I could see somebody young getting you check out. I don't feel like they do it as much anymore, but remember when they'd always be like, I guess they do. I just say no quicker.
Right.
Where they're like, you want to fill this out and get 10% off your purchase today?
Oh, yeah.
And a lot of people do it and then maybe lose track of time, or I've had people move. And the thing is, too, I mean, if you're moving and you're doing all the things, is somebody that you owe $200 to at the top of your mind?
No.
So potentially it would be an oversight where they just got busy and they kind of forgot they had that debt.
Right.
And they never changed their address, and then next thing you know, you're getting hit with that. Well, that $25 late is going to cost you a lot more in the long run. But people were like, I don't understand. It was just $25. And I'm like, right. And you might as well miss your car payment that month, because it's very similar as to how it hits your credit report. It was just
I see
crazy.
it in students too, getting a credit card right off the bat. They're
yeah.
500.
What'd they get?
The credit card.
Like vultures.
No. But yeah, they'll get it right off the bat, 500, and make one payment, get it increased to $1,500, $2,000, and then miss a payment, and then it's like they just don't realize how it's going to affect you.
It seems so small, right?
Yeah.
It just seems like such a small amount. And then I've had people call me. They're like, listen, I called my credit card company. I told them to lower my limit. I'm thinking, why would you do that? But in their minds, they believe that if they have less access, that a lender is going to look at that in a better light.
Good way, yeah.
But they don't, because they want to see that you have access to 1,000 and you've only spent 200.
Right.
But if that person, that same scenario, calls and says, hey, I don't like that, I want you to lower it to 300. Well, now you had access to 300 and you spent 200. Like you're maxed out, right? I mean, from a credit reporting, agency, I mean, it looks like this guy's, one bump away from bankruptcy. Not really, but you see what I'm saying?
Yeah.
It does impact your score that way, though.
Well, it's also with credit cards, if you only use it for very limited time, you say, I'm just going to close this card and do away with it. So you've lost that amount of credit available, so it's kind of in the same way.
Same way, exactly. So, I did want to, the reason why I kind of fell in that hole a little bit was I kind of want to defend FHA a bit, because they do allow that flexibility in the credit. And it should be allowed, right? There should be, because it's not the only piece of the puzzle. I think we've talked about that every podcast so far, that the credit score is just one piece. We're going to look at your debt to income. I mean, if your credit score is low, but your debt to income is very, very low, maybe you were in college last year and now you're a nurse, and now you're making $90,000 a year and doing quite well.
Right.
And you can afford a house. And so it kind of takes those scenarios into account when approving it, right? And so the 3.5 and the 10% are not guaranteed. Those are just minimums. If your score falls within those thresholds. Yep. And so as far as the rest of it, it's so many pieces. I mean, if you have a nice 401k, people are like, why are you asking me about that? And I'm like, well, if I put it on your loan application, it makes your loan application look stronger. Because I've had people, I think, reluctant to tell me about
Right.
it because they're thinking that I'm going to ask them to tap into it. And that's not the case. It's just I'm trying to build a financial picture for you that will get you approved. And if you do have, $40,000 in a 401k, you should be proud of that. You should be guarding of it, right? You shouldn't. You should say, I don't want to tap into it. But that's not where I'm going with it. Where I'm saying is, let's put it on there, because then when the underwriting systems are looking at it, it's like, okay, if things go completely sideways on this deal, before they're going to lose their home, they could tap into this and access some money to get them through a rough spot, right? And so, anyway, those types of things help. And then with USDA, or you have another question about FHA?
Well, it's funny because with the 401k, even with the government situation, I've had to tap into mine, but it does take a process.
It does.
A good 6 weeks before you actually.
Wow.
But what about the USDA loans? There's no down payment required.
That's where they come in flexible, because a lot of their other flexibilities, they don't like. FHA is more flexible on debt to income than USDA. They're more forgiving in credit situations than USDA. So where they really help is if you don't have a down payment, right? And no, I mean, they do go down to a 580 credit score again, but they're going to require you to have truly rebuilt yourself, and they're going to look back 12 or 24 months and look at your credit and decide if you've had bumps in those past 12 to 24 months. I mean, outside of medical, you're probably gonna have to wait on a USDA loan. But if you straighten your life up and you still have a 590, and last 2 years have been good, and you have a good job, and all the other things are good.
What about deferred student loans?
So
Just out there for all these younger.
right, they're taken into consideration as far as the deferred. We do add a payment to it, but it it's a fair payment, right? It doesn't disqualify you,
Right.
So I mean that's all good, and it doesn't hurt you in any way, except for we're gonna add a payment to those deferments.
So on these government loans, as for the property itself, can you have like a main residence and a garage apartment, and can you have two buildings that are livable, or you can have a business, or are there limitations on these government loans on what you can do there?
So FHA is far more flexible in that arena as well.
Okay.
USDA, they would allow a garage apartment, but it can't be, or like a unit out there, but it can't be income producing, right? So there's some restrictions there. Where FHA, I mean, they allow 1 to 4 units, right? So if you got like a young couple, guy, girl that is kind of wanting to get into the rental business, they could buy a 3 unit or 4 unit and live in one of them, and they would have all the access to all the benefits of FHA, 3.5% down, the as far as the flexible with the credit, that kind of stuff. I mean, all of those things apply even on a multi-unit. And I mean, I don't know why somebody wouldn't do that. The only thing is, in the markets I work in, there are not a lot of multi-units that come available. And a lot of times when I have seen them, they're rough.
Yeah.
Sometimes
cash or conventional.
right. They seem like they're
Mostly cash.
they're ready for someone else to put the money back into them to get them
Build
to
the equity,
to a standard again. Not always though. I mean, I'm sure there's some fantastic duplexes out there that pop up, but
Rarely.
I think that
I'm still looking for some.
Right. But I think if they did pop up, maybe somebody who qualified for an FHA loan would think they wouldn't qualify for that property, right? Because it is multi-unit.
Right.
But you can use the FHA for multi-unit. USDA, not so much.
Gotcha. So can a buyer use someone for money gifted to them if they can't make down payments, or they
Absolutely.
I mean, closing costs, or how does that entail with
So-
the government loans?
The government loans are flexible as far as you said closing costs. So like if you were to ask the seller to pay your closing costs as a seller credit, they allow you to get up to 6% on the USDA and FHA,
Okay.
which is a big number, right? Because I mean, 100,000, that's
Sure.
$6,000. So
Absolutely.
200,000, I mean, it's 12,000. You don't need that much, right? So they build that
Go
in
up
there.
to.
Yeah, it's up to 6%. It's typically in your larger loan amounts, you don't actually need the 6%, but you could negotiate it that way. And they both allow gifts as well. And the
Okay.
gifts, there are some parameters as to like who it can come from,
Okay.
right? It definitely can't come from the seller. It can't come from the agents. And there is a list of relationships that are acceptable. And
Those that don't qualify?
yeah. So, but most of the time, you do qualify for that gift, right? Because unless you're getting a gift from a really strange location, I mean, the people that are normally willing to gift you money to buy a house are your parents, your brothers, somebody like that, like not maybe aunts, uncles. So normally a complete stranger is not going to gift you the money, and if they do, there's something else going
Questionable.
on, right? So, there's something there that's where it would need repaid and that type of
Well,
stuff.
something.
In regards to interest rates, are USDA loans generally lower than the FHA? And
They're
does that
very-
depend on your...
Very comparable in rate wise. Right now they're hovering right at 6, and again, there might be some adjustments based on credit score. So somebody that has a lower score might not hear that 6% rate, but somebody with a more normal score is probably going to be in that ballpark.
Right.
And it's about the same whenever I compare the two rate wise. The FHA and USDA are typically similar.
So on appraisals with these two, is there something that stands out? Is there bigger hurdles to get through on appraisals for the government loans, the FHA specifically and the USDA?
So, yes and no. The reason, because a conventional loan is going to require that house to be livable. It's going to require it to have all safe, sound, secure, those things, right? So you're not going to get a conventional loan on a house that's missing a kitchen, or somebody started to remodel the bathroom and just didn't put it back, that kind of stuff. FHA and USDA, they are going to have a few extras, right? I mean, they're going to probably look a little bit more for safety features like handrails. There's always seems to be kind of a hot topic anymore because it's not consistent with whether we're flagged on it or not when there's an integral garage. The drywall between the house and the garage, there seems to be an appraiser opinion there because some appraisers require it and some don't, and it's the luck of the draw as to which appraiser you get. So that would be something that would lean you more towards a conventional loan and I've seen conventional appraisers try to ask for that, right, to have that because they call it a safety issue.
Right.
But for the GFCIs, maybe a little more with those two loans versus the conventional.
Peeling paint?
Peeling paint, yeah. I mean, that's another thing that we see. But again, you're not going to get a conventional loan on a house that's
unsafe.
Yeah, I mean, that it's deplorable. I mean, and that's people are like, why are you asking for this? It's conventional. I'm like, what do you mean? Like, this house is a mess. So you definitely can. You will see a few differences, but it's not as big as you might think. I feel like when I started in the industry 25 years ago, the conventional
But you're only
standards were
29.
here.
You've only wow. You
Ish,
started
right.
early.
The conventional requirements were here, and the FHA requirements were here. And I believe over time, in my opinion, they've increased the requirements here and they've cut back a little bit here, right? So you're still going to have a small gap, but the gap has closed so much over the years.
And I hear the conventional is getting a little tighter too.
That's what I'm saying. Like, I feel like they've changed it, and
yeah.
a lot of I don't know. Some of them you have to agree with, right? You probably do need to
sure.
bring your house up to certain standards. I don't know about a handrail, but
But they do kick plates and everything on stairs, egresses, and they're
where it gets a little squirrely for me is you might have a front porch, right, and it was built and designed with a little bit of a drop off of it, and there's never been a railing there. It would look crazy with a railing. I hate those because you have a situation where now someone needs to put a railing up, and it's going to look awkward.
Ridiculous.
And then all they're going to want to do is take that railing down as soon as they move into the house because it just doesn't fit. And then, sometimes you'll have like coming down to a basement, you might have like one side that's open. But aesthetically, that's what the design was, right? That's the way it's supposed to look. I mean, I guess you could fall over it, but like you also have a handrail on the other side that you could go down and help yourself if you needed that sort of help. But nonetheless, I mean, that might be something that you would get away with conventional that you're not going to get away with on FHA or USDA.
Gotcha. So, is there anything that you wish buyers would understand better about the government loans or misconceptions that you always hear? What maybe realtors are not doing that would benefit the loan process better for those government loans?
Well, and I think we've kind of touched base already on the hot spots. FHA isn't a first-time home buyer loan. That the down payments, if you have 3.5, you should be good because that's not necessarily the case, right? And again, that's where they'll Google or a realtor will be like, I don't know why they're asking you for 10%. You only need 3.5. Right. Well, that's not true, because it's a different scenario, right? We took all of it. So those, I do feel like we've kind of touched base on a lot of the hot topics that I run into, that I see that people are like, and then the appraisal thing, I mean, everybody thinks a conventional loan is going to be so easy and just fly through. And again, you know what I mean? Like it kind of used to be like this, but now it's like this. I mean, there's still a little bit of a gap, but it's not as big as it used to be. And a lot of the repairs are obtainable, right? I mean, if you have if you need peeling paint, let's get somebody out there to scrape it and put some paint on it and let's get it closed, right? And that, if you are somebody that's going to limit yourself as a seller to a conventional loan, you better hope you have a great property and you got a price right, because if you're not and you have the opportunity to sell it to somebody with an FHA loan and you turn it down just because of that, and you're going to wait for the next person, if that next person doesn't come for a while, you might wish you would have gone ahead and moved forward with the FHA loan.
There's definitely a reputation out there that the FHA loans are harder on sellers. Where do you think that comes from, and is it actually true?
Realtors.
Well.
Right. Conventional loans are just naturally easier because you have to have a little better credit. There's not really a lot of 0% down conventional loans. We discussed that the appraisers are slightly lighter, and they have in the past even been more light. So somebody that's been in the game for a while is going to say, hey, conventional is the way to go. But, I mean, no. I mean, as far as getting the loans through, they're both of them are tough. But conventional is naturally going to be a little bit easier because the things I describe a little bit better client, right? You have to have a little better credit score to get conventional. You have to have a down payment to get conventional. You have to, you know what I mean? Those things are going to lean towards, if you have that client on the other end, it's likely going to be a little smoother of a process, where FHA is a little more forgiving. And when they forgive, I mean, they're still going to want documentation, right? So there's going to be a little more documentation. Now, not everybody that gets an FHA loan is because they have like lower credit or anything like that. I mean, sometimes they want to take advantage of some of the other advantages, which would be like the 3.5% down, right? And maybe if you don't qualify for USDA because you make too much money and you want a loan that you have to put a reasonable down payment, then that might be a great loan for you. I mean, and you might have a 780 credit score and go that direction.
And you don't have to be a first-time home buyer for the FHA.
No, you don't.
You can be, but you don't have to be.
In the closing costs, those sneaky little extras, can buyers roll them into the loan, or do they need to bring cash to the table?
The only way to roll them in is to negotiate for your seller to pay them. Now, USDA, that is one place where they are a little more flexible. If the property appraises a little bit higher, you could actually roll those in. But you're also rolling the dice too, because if your client doesn't have it,
Right.
and you're hoping that the appraisal comes in high enough that you'll be able to roll it in, you won't know until that appraisal comes through the door
Right.
whether not that's a viable
Right.
option, right? So you're better off to ask the seller to pay for it up front, even if you have to negotiate a smidge higher price. But no, you can't just roll them in exactly, right? You either have to have on FHA, it doesn't matter. I mean, it could appraise for $300 and you could be paying $150, and they are going to go off the $150 amount. So it's always best to, if you need that assistance, to get the seller to pay it for you.
So in wrapping up our series, why do you do this? Is there a story that you have helped someone and it just said, wow, this is why I do what I do?
Some days I wonder why I'm doing what
Even
I'm doing.
doing it.
Yeah. Some days. I like my job a lot. I enjoy the people. Like, I like working with the families, and I am good at it, right? So I'm good at helping people. I believe that, FHA parameters are going to be the same with me. So, oftentimes, I mean, banks can vary, but with me versus other lenders. But I believe that I understand the product better, so I can help you more because I do know the ins and outs, and I do work hard to understand exactly the guidelines and how they're perceived and by the underwriters, so that way we can position you better to get a house. And I like that. I mean, I like kind of being the smart guy in that
Right.
world.
Switch gears a little bit. What is maybe the funniest thing you ever, or most unexpected thing that a buyer has questioned you about, especially like financing and stuff? Has there been any?
Having the big shoebox full of
Right,
items.
right.
Finding the catnip.
Yeah, no, I mean, I wish Mitchell was here because I feel like he and I have a lot more because we have had just so many people. Mitchell's my partner in crime for the last, I don't know, probably 20 years at this point. I'd have to do the math.
Right.
But like, we had this one lady come in and she starts on to us about something, and she was an older lady and she was just a little frazzled, right? And she by the time she was done talking to Mitchell, she told him that she had faxed it to his email, and but she starts, I forget what she said, but she used every method of like the transportation to give
Get
him
that.
but as far as I don't know. I mean, we hear some crazy stuff.
I'm sure you
those
do.
people are like,
I'm sure you do.
they're like, I'm just gonna be straight up with you. I'm like, what? What's coming out now? And most of which, if I go too deep into a scenario,
I don't want to know.
somebody watching this might be like,
Yes.
that was me. But yeah, no, we've had some crazy stories over the years. The big thing that is kind of crazy though is when people think they're smarter than us. And I'm like, I promise you, I've done more mortgages this
Right.
week than you'll do in your life, right? And I mean, and that goes for even people in the industry, And I'm like, I mean, I'll have people, they're like, did you think of doing this? And I'm like, I assure you I did. Like, I promise you. And I love the banter, so I'm okay with
Right.
kind of chatting through a situation. But the worst thing that somebody could do is try to like repair their own credit. I mean, you might hit the jackpot and do all the things right, but the likelihood is not good. And I mean, I have people that like they want to drive the bus. And I'm like, if you want to drive the bus, we'll let you. But like, don't blame me when it doesn't go right, because we're going to show you the way that we normally do things,
Right.
and the way that we have a proven track record that get us there, right? But some people are like, no, I won't order the appraisal till I'm through underwriting. I want my loan final approved until I order the appraisal. I'm like, that's fine. Keep in mind, the underwriting process, can take a while. I mean, a loan is 30 days. I mean, you really could get it a little quicker these days if you can get an appraisal and title work back.
Right, that's a big deal.
But let's just say a loan's 30 days. That's if everything's done simultaneously. If you don't let me order the appraisal till day 20, you're not closing in the next 10 days.
Right.
So people just want to sometimes be in charge, and I'm like, it's okay. I'm fine with it. And just be sure everybody knows that, like, you're making us do this one step at a time. And I mean, it might take 12 months based on what your plan is, but if that's your plan, as long as everybody else is aware, then I'll do it too. If you would like my help, then I could get you the rest of the way through. But I don't know. That he hit me up with the tell me a time.
No,
those tell me a times are tough, right? Because I'm like, or tell me a time when you had to, like a interview type question, which I'm like opening up every loan I've ever had in my box.
And I already know that you're the type, and especially Loan Depot, they seem to dot every I and cross every T. So somebody saying that is like, you've done them. This is you. You could probably do this in your sleep.
Right.
Yes.
Yeah, and we really can. I mean, like, if you only want to talk to me, that's fine. I'll do it. But keep in mind, if you're willing to talk to my team also, you're probably going to get further along, right? Because, I mean, I'm out, hanging out with cool people like you, doing things like this.
There you go.
Right?
Well,
and if you're trying to reach me right now, which my phone is on vibrate, and I know I've missed like 30 calls, so I'm sitting here.
Wrap this up.
But, no, it's okay. It doesn't bother me. But if you call my processor, who we pay to be at her desk, I used to say like chained to her desk, but then people were like,
That wasn't.
but anyway, we if you let that also be part of your part of your process, and let the flow go the way it should.
You don't always have to talk to me, but
Right.
I'm driving the bus. But
It's fine, but you might talk to me later tonight, or with something
week from now.
something that could have been done this morning. Something that could have been done in 5
no,
seconds.
I need to talk to Ray. Need to talk to
Right.
Ray.
I don't blame him. I'd want to talk to me too. Right.
All right, so let's do something fun.
Uh-oh.
Loan Depot. If it were a movie, what would it be? What you do every day in Loan Depot. What kind of movie? Is there a movie title that describes you all? Did I put him on the spot?
Home Alone. You know what I mean? Like, yeah, right.
No.
Most days, I feel like we're just like running through life trying to figure it
Where's
out.
Kevin?
Right.
Where's Ray?
Right, exactly. So potentially, it's funny, like my team, like Michelle, will be like, oh, Ray with his stuff, because I really do try to push the envelopes for people. And she's more conservative. She's like, well, if we, like if your debt to income can go up to 50%, I might let it go to 49. She's like, well, let's try to keep it at 47, Ray. You know what I mean? Like, let's leave a little room for wiggle. And I'm like, well, I've, had him bring me the pay stubs, and I worked through it all, and I feel comfortable with this. And that gives her anxiety.
Gotcha.
But the Home Alone piece, like, I feel like I probably am Kevin running around, and
I see that.
some days,
I see that.
some days Michelle might be the guy trying to kill me.
And finally, Ray, if you were weren't in lending, what would you be doing instead? And be honest, rock star, chef, or something totally unexpected.
Rock star.
No, I wish it was that. Do I get skills that I didn't have, or that I don't possess also?
Yeah, I think you have more
You can't be
skills
like
than what you
Spidey-Man or
think.
something.
I can't be a rock star. Like, we watched Dancing with the Stars last night. I don't think I could do that, but it looks fun.
Yeah.
I mean, this morning at the gym, I was trying to do the where you kneel down and like, did you watch it? So my 19-year-old has a whole like group that they watch the Dancing with the Stars.
Oh.
And her girl gang was out the finale, right? Because it was like Thanksgiving week, so I watched that one with her. And then yesterday there was a Christmas one, but
That's
so I
cool.
know a little more about it than
Okay.
It was supposed to, but there was it was like a lunge, but you didn't pick up your leg, and so I was trying to tell the people at the gym about it, but I don't think I had that skill.
The guys at the gym, that's what you're talking
Well,
about.
Fairmont State, I am reaching out to you because I think Ray needs to be on the next Dancing with the Stars
Yes.
up at Fairmont State.
I already did it.
Oh,
Did you? How'd you
I won.
Did
Listen,
you?
yeah.
Which one did you do?
It was 8 years ago.
Oh, wow.
Oh, you would have been probably. I was there.
Oh,
Was
really?
it the first one?
No.
Oh,
I
okay.
was probably, I don't know what year it was, but I'm gonna say like 5 years, because by the time I did it, they had moved from the older, what's that, the coal bank?
Yeah.
They had moved over to the newer building.
Well, maybe we need to take all the winners and
Oh,
have
a winner's circle.
Wouldn't that be cool?
Fairmont State. Mm-hmm. Where
Yeah,
you
I
at?
think
6'7".
Right. Yeah, I don't think I'd be a pro dancer. I could be a tour guide. I think I'd like to be a tour guide in my next life, and I may actually do that later in life.
Yeah.
Right? I start go around on one of these buses and get myself a microphone and make up stuff about what happened in the city that I'm talking
Make
about.
up stuff.
Right?
Huh?
You know, like a gangster tour or something.
Yeah.
I think I would like that. But
That'd be cool. All the speakeasies in town, you know?
yeah,
Hey.
exactly. We can't
Ray,
talk about those either.
It has been so much fun, and I'm so glad you came on for the series that you did for us, because it's so much information packed in there and that people normally don't know about. So you have been a wealth of information. Loan Depot, we're so glad that you're just down the street and home people, and just here that you don't have to do something over the internet or somebody that you never would put a face to, and can walk in their office if you wanted to. So we're
sure.
so glad that you came on board, and we're right behind you on Loan Depot.
Awesome. Thank you guys. I appreciate you having me.
And that's a wrap for us, and what a journey it's been with Ray Logue, from VA loans, the breakdown of USDA loans and FHA loans. So we really appreciate Ray being on here.
For sure. And most of all, we want to thank Santana Withrow with Affinity Films. She is our director, and she keeps us in line, doesn't she, Chris?
Yes, and if you enjoyed the episode, please share, like, and follow us.
Absolutely. I'm Tammy Halford.
And I'm Chris McLaughlin, and see you next time with Real Talk with the Pros.